This video is on how you can reduce your tax by increasing deductions allowed legally. So we'll show you how you can do this. Yes, friend, you can reduce your tax legally by simply increasing your deductions allowed. That is increasing allowable expenses. Section 20 of the NTA 2025 states that deductions allowed are the same as allowed expenses. Allowed expenses are the expenses which the Tax Act allow you to deduct from your gross income or turnover to arrive at your profit before tax. Consequently, subtracting deductions allowed and increasing deductions allowed to arrive at your profit before tax, what the taxman calls accessible profit, are both legal and ethical. So you should adopt them in tax planning, tax avoidance, and tax reduction. Our duty is to show you how, and this is exactly what we want to do here. Many people do not know, or if they know, do not sufficiently understand the golden rule or principle of deductibility of expenses. Consequently, the taxman disallows so many of their expenses and thereby impose so much tax on them. This compass or video is specially dedicated to educating you and clearly explaining what deductions are allowed and deductions not allowed are and how you can harness them to reduce your tax. So just follow us to the end. In addition, over the years of our tax education and practice, we have dug out and formulated the golden rules, the general rules, and the silent principles of taxation, which have sufficiently assisted tax stakeholders in their understanding, application, and compliance of the tax laws. These golden rules include the golden rule of tax freedom, taxability of persons, taxability of incomes, vatability or taxability of supplies, deductibility of expenses, eligibility of withholding tax, chargeability to gains, loss relief, capital allowance granting, and many more. All you need to do is to just follow us as we release these videos for tax education. And to get the videos hot and fresh, kindly like, please, subscribe, hit the notification button now, and share so that as many people as possible will be notified and sufficiently educated. And you know what? Your life will never remain the same. So, what are you going to learn in this video, in this particular compass? They include the golden rule of tax freedom, distinction amongst tax deductions, fundamental meaning of deductions allowed and deductions not allowed, format for computing income tax, the golden rule of deductibility of expense, key components of the golden rule of deductibility of expense, the meaning of wholly and exclusively, key considerations for wholly and exclusively, common characteristics of deductions allowed, common characteristics of deductions not allowed, operationality of deductions allowed, specific deductions allowed in the Nigerian Tax Act, specific deductions not allowed in the Nigerian Tax Act, implications of non-allowance of deductions, options and remedies available for disallowance of deductions. Some tips on how you can increase deductions allowed and decrease deductions not allowed. Some tips on how you can better describe your expenses. List of the 22 interdependent compasses about tax corp and the authors. So the question now is, which some of you may have known, is what's the golden rule of tax freedom? Dear friend, do you want to be free from tax wahala? No disturbance of your sleep by a taxman? No knocking at your door by a tax lady? No receipt of long queries by your business from a tax controller? No receipt of unsolicited reminders or threats by your company? No blocking of your bank accounts by tax chairman? No bargaining to you by law enforcement officers? No forceful entry into your business premises by enforcement uh, officers? No threat of imprisonment by a law court? No selling of your business and or its assets without a court order after the tax has become final and conclusive by the Nigerian Revenue Service? Dear friend, if your answer to the above compound question is a capital yes, then obey the golden rule of tax freedom. So what's the golden rule of tax freedom? And it is very simple. It is the three C's. And what is the three C's? Comply, comply, and comply. Now, before we go on, let's make some distinctions amongst the tax deductions because there are some tax deductions here in the Tax Act which are confusing to some people and want you to have a good understanding. To avoid the confusion, it is very important to make clarifications among the various deductions in the Tax Act. There are four of them, and they are deductions allowed, deductions not allowed, total deductions, and eligible deductions. Section 20 of the Nigerian Tax Act defines a deduction allowed as an expense which the Tax Act allows to be deducted as an expense in the settlement of the profit or loss from a trade, business, profession, or vocation. And Section 21 of the NTA defines a deduction not allowed as the opposite of deductions allowed. Section 27 and 28 of NTA state that total deductions comprise loss relief, capital allowances, exempt income, and final tax income. While Section 30 of NTA says that eligible deductions comprise personal income reliefs such as National Housing Fund, National Health Insurance Scheme, and pension contributions, interest on owner-occupied house, life assurance premiums, and rent relief. So what's the fundamental meaning of deductions allowed and not allowed? Section 20 of the Nigerian Tax Act defines a deduction allowed as an expense, which the Tax Act allows you to be deducted as an expense in the settlement of the profit or loss from a trade, business, profession, or vocation. Meaning, if the tax law does not allow an expense to be deducted as an expense in the settlement of profit or loss from a trade, business, or profession or vocation, that expense does not qualify as an allowable expense and therefore cannot be deducted. You lose it and your tax becomes more. Conversely, Section 21 of the Nigerian Tax Act defines a deduction not allowed as an expense which the Tax Act does not allow you to deduct as an expense in the settlement of profit or loss from a trade, business, profession, or vocation. Disallowance is outright. You lose the money straight away. Now, you want to reduce your tax legally. So to do that, the first thing you have to do is to know the format for computing income tax. Why? Because income tax is a percentage of your chargeable income. So you have to know how chargeable income is calculated. So that's why we're showing this format. So to calculate chargeable income, you follow this table. First is your gross turnover or income. From there, you less deductions allowed and you come down to profit or loss before tax, which the taxman calls assessable profit. Then you less total deductions and you now come down to total profit or income. Then you less eligible deductions. You now arrive at chargeable profit. It is this chargeable profit or income that you hammer the approved tax rate and you get your computed tax liability. Meaning, if you want to reduce your tax liability, you have to reduce your chargeable income. So how do you reduce your chargeable income or profit? So you can do any of the following. First, you can decrease your gross turnover and increase your deductions legally. And this is what we want to show you here. Now, what's the golden rule of deductibility of expense? Because before you can reduce your tax and increase your expense, you have to understand how an expense is deducted. You must understand the rule, the basic rule, the golden rule that that regulates deductibility of expense. So, friend, tax is not imposed on gross turnover or gross income, but on the balance of gross turnover or gross income, less all deductibles, which you have seen in the format. A major component of these deductibles are expenses, and they are only deductible when they pass the golden rule of deductibility of expense. So, what is this golden rule of deductibility of expense? It is that in ascertaining the profit or loss from a trade, business, profession, or vocation, all expenses which were wholly and exclusively incurred, please mark my words, all expenses which were wholly and exclusively incurred in that period in the production of the income shall be allowed as deductions in arriving at the profit or loss. This is also called the deductibility criteria, the deductibility principle, rule, or test. The more you understand and apply this principle or rule, the less tax you pay. Please note very importantly that the Tax Act specifically stated wholly and exclusively incurred. It did not provide for partly or dual purpose incurrence or prorating, where the expense is incurred partly for business and partly for some other purpose. Meaning, where the expense is partly incurred for business and some other purpose, the expense will be wholly disallowed, except where the tax authority decides otherwise. So you lose your money and more taxes are imposed on you. Now, let's look at the key components of the golden rule for deductibility of expense. There are 7 of them. The first is in ascertaining the profit or loss. The second is from a trade, business, profession, or vocation. The third is all expenses, wholly and exclusively incurred in that period and in the production of the income. The golden rule of deductibility of expense relates to ascertainment of profit or loss, not ascertainment of income. It relates to a trade, business, profession, or vocation, not employment. It includes all expenses, not selected expenses or a few expenses. Must be wholly and exclusively, not partly or dually. Must be incurred, whether or not paid. Refers to a clearly identified period in which the income is produced, not vague period, and refers to the production of a clearly identified income. So let's see if we can clearly make a good understanding of wholly and exclusively. Very important. What does wholly and exclusively truly mean? Wholly and exclusive means is largely a question of law and commerce. Consequently, there have been so many cases on the golden rule. In the UK, there is a manual largely devoted to clarification of what constitutes wholly and exclusively. Consequently, you will deepen your knowledge of wholly and exclusively by what is expressly stated, what is covertly implied, and what is neither expressly or implicitly stated, and what is not. So let's explore. The overall focus of wholly and exclusively is the sole purpose. The question is, what is the sole purpose of incurring that expense? An expense incurred solely, not primarily for the business, meets the wholly and exclusive test. An expense incurred dually for the business does not meet wholly and exclusive test. However, tax authority can apportion where the different components can be clearly identified and separated. Wholly and exclusive also means allowed expenses will be taxable as income on the recipient. Consequently, gift is not allowed because it is not a taxable income. Wholly and exclusive does not require necessary and reasonable tests, which have been expunged from the Tax Act. Now, here are the key considerations in determining wholly and exclusive of an expense. In determining whether an expense meets the wholly and exclusive test, the following considerations have to be made, and they are the focus for incurring the expense. What's your focus? The sole purpose for incurring the expense. Whether there was a duality of purpose in incurring the expense, you lose it. Whether there was a primary purpose for incurring the expense, you lose it. Whether there was an ancillary or incidental purpose will be considered. Whether the expense is a taxable income on the recipient, yes. Finality and recoverability of the expense, you lose it if it is recoverable. Presentation of sufficient proof of incurrence. Whether the expense is incurred, proposed, or estimated. If it's proposed, estimated, it cannot fly. Whether the expense is incurred, paid, or accrued. Whether the expense is private, personal, or domestically related, you will lose it. Now, let's look at the common characteristics of deductions allowed. What distinguishes them from deductions not allowed? The sole purpose of incurrence of deductions allowed is business, purely business, not personal. They are solely, wholly, and exclusively incurred for the business. There is no primary purpose, but sole business purpose, no dual purpose. They are incurred for the production of a clearly identified income. They are of revenue nature and not of capital nature. They are cost to the incurrer and taxable income to the recipient. They are clearly and properly described, no ambiguous description. They are not unrealized, estimated, proposed, or projected. They must be incurred but not necessarily paid. They are final and the business bear the burden of the expense. They are not reserved or recoverable expenses. They are objective and not subjective. They are properly proven with sufficient documentary evidence. They are not artificial or fictitious and are carried out at arm's length. They are not fraudulent or forged. Now, the opposite is deductions allowed. So let's look at the common characteristics of deductions allowed. The sole purpose of incurrence of deductions not allowed is not business. They are not solely, wholly, and exclusively incurred for the business. That's why they are not allowed. They usually entail multiplicity of purpose, outside business purpose, domestic purpose, private purpose. They are not incurred for the production of a clearly identified income. You can't point to any income they were incurred to produce. They are of capital nature and not of revenue nature. You can't deduct the cost of a building from revenue. No, it's of capital nature. They are not cost to the incurrer and not taxable income to the recipient. They are usually vaguely and ambiguously described and fraudulent. They are unrealized, estimated, proposed, or projected and subjective. They are not final and business may not bear the burden of the expense. Sometimes they are reserved and though outlays could be recovered. They include consequences of offenses, failures, and bad acts like fines, penalties. They are not allowed. They are not properly proven with sufficient documentary evidence. They are artificial, fictitious, and are not carried out at arm's length. Now, claiming an optionality of deductions allowed. How does it happen? Friends, see, deductions allowed are not granted to you automatically. No, by the tax act, by the tax authority. You have to claim it. I have to do that in writing, not orally. To claim a deduction allowed, you have to do the following seven things. And what are they? One, you have to write or include the deduction in your tax computation schedule. Two, you have to show incontrovertible proof of incurrence or payment. Three, you have to provide documentary evidence, invoices, receipts to show that you incurred that expense. Four, you have to provide accounting or record evidence when it is required. You have to show proof of the wholesomeness and exclusivity of the deduction, not duality. You have to show proof that the asset was used solely for the trade or business. You have to show proof that the asset was used for the purpose of production of the income. Show evidence that the recipient is registered for tax and has a tax ID. Specific deductions are allowed in the Nigerian Tax Act. Now, here are the deductions the Nigerian Tax Act specifically stated that are allowed. First is interest on debt or loan employed in generating the income. Rent, leases, premiums incurred in respect of land or building, your rental expense. Salary and wages or other remuneration paid to employees. Benefits or allowances paid to employees, or what we call benefit in kind. Repair or maintenance of premises, plant, machinery, or fixtures. Renewals or alteration of implement or utensils and articles. Expenses incurred for establishing, preserving, or defending title of an asset. What expenses you pay to your lawyers. Contribution to staff pension or other retirement benefit funds approved under the Pension Reform Act. Damage to or loss of stock or inventory of a trade or business when fire catches your stock. Bad or doubtful debts incurred in the course of a trade or business. expense incurred by a trade or business on research and development, any other allowable expense incurred during any previous period, any expense incurred within 6 years period to commencement of business, prior expenses, pre-commencement expenses, any expense incurred within 6 years prior to commencement of business, that's pre-commencement expenses. Dividends on monetary distributions made by a real estate investment company duly approved by SEC. Compensating payments made by a lender to its approved agent. Any expense incurred by a person on assistive devices and disability related products, including hearing aids, wheelchair, donations to approved funds, bodies, and institutions. Specific deductions not allowed. Just like you have the specific deductions allowed by the Act, so also the Act stated certain deductions which are not allowed. One is capital repaid or withdrawn from a trade, business, or profession. Any expenditure of capital nature. You buy a motor vehicle, you don't deduct the cost because it's of capital nature and not of revenue nature. Domestic or private expense. Expenditure on asset not used for the purpose of trade or business. Any sum incurred under insurance or contract of indemnity. Taxes on profit or incomes levied in Nigeria or elsewhere. Payment to savings, widows, orphans, pension, other retirement benefit funds under the Pension Reform Act. Depreciation or impairment of any fixed asset or investment. Any sum reserved out of profit, which is not bad or doubtful debt. Any payment to a connected person that is not consistent with the transfer pricing regulation. Any expense incurred in deriving an income that is exempt from income tax. Any expense allowable as a deduction in determining chargeable gains under the Act. Penalty or fine imposed under any law. Any tax or penalty borne on behalf of another person. Any compensating payment made by a borrower which qualifies as dividends. Any compensating payment made by an approved agent which qualifies as interest or dividends. Any expense on which value added tax due but was not charged, collected or paid in the case of imported items. Any expense on which applicable import duty or levy was not paid. When you don't pay withholding tax on any item, any expense, it will not be allowed as a deductible expense. And if you import goods and you don't, where you're supposed to pay import duty or levy, the cost of those goods will not be allowed as deductible expenses. Now, what's the implication of non-allowance of a deduction? The primary implication of non-allowable deduction is that it will not be allowed as an expense in the statement of profit or loss of the trade, business, profession, or vacation. If it has been deducted before, it will be reversed. They will reverse it. That's what we will reverse it. And if it has not been deducted, they won't allow you to deduct that. In that case, you lose the money. You lose everything. So you have to be careful. However, depending on how much you prove your case and convince the tax authority may take any of the following actions. They may disallow the entire expense if you were not able to prove. They may disallow only a part of the expense, or they may allow the entire expense. Now, what are the options available to you when your expenses are disallowed? There are four of them. The first is accept and move on with your life. The second is refuse and argue your case with the tax authority. And the third is refuse and appeal to the tax authority because you have the privilege to do that, you have the right to do that. And lastly, the fourth, you can refuse and appeal to the new created office of the tax ombudsman. Now, here are some tips on how you can increase your deductions allowed and reduce deductions allowed and thereby reduce your tax. First, please, we have always been emphasizing this. Please know your tax law well, not just your tax advisor or tax corp. Please know your tax law well. Second, be proactive. Plan your tax matters ahead. Third, plan all year round, not just at the tax time. When tax arises, you start planning. No, please plan all year round. Understand deductions allowed and plan to increase them legally, not illegally, please. Understand deductions not allowed and plan to decrease them. Again, do that legally and not illegally. Be creative and innovative, but please don't be fraudulent or evasive. Corporatize your business. Monetize your personal efforts in the business. Don't mix other expenses with business expenses. There should be business and there should be personal affairs. Even with your banking, don't use your personal account for business. You are causing trouble. Describe your business expenses sufficiently and clearly as indicated below. Don't give room for ambiguity or interpretation. Document all business transactions. You will require them later on. Keep comprehensive, proper, and accurate records of your transactions. Deduct all taxes and pay all taxes and duties on assets and expenses. If you don't do, tax office will not allow those expenses. Claim all expenses timely and sufficiently. Most importantly, please consult and stay with tax corp for all your tax matters. Now, here are some tips that you can use to better describe your expenses so that they can be allowed. First, be business focused. 2, be creative and innovative. 3, favor allowed deductions. Be exact and apt. Standardize your descriptions. Describe sufficiently. Don't trade details for brief. Avoid ambiguity. Avoid vagueness. Be very clear, please. Avoid personal, private, or domestic description. Friend, here we come again to the list of the 22 interdependent compasses. So all you just have to do is look at this list. Any particular tax subject that you want to deal with, just go to our YouTube channel and you pick it up. And if there is any tax subject you want us to deal with that is bothering you, please let us know and we will deal with that. So you already know about Tax Corp, but I want to tell you as well that Tax Corp is a Nigerian tax consultancy firm which specializes in tax matters. Prince Chid, FCA, FCTI, MBA, is a principal consultant. Prince Chid is a licensed fellow of the Institute of Chartered Accountants of Nigeria. He's also a licensed fellow of the Chartered Institute of Taxation of Nigeria, CITN. Tax Corp and Prince Chid have provided tax services to numerous individuals and corporate bodies in both the public and private sectors, locally and internationally, since 1990. About 3 decades now, more than that. The beneficiaries include the Nigerian Revenue Service, which was formerly the Federal Inland Revenue Service, Revenue Mobilization, Allocation and Fiscal Commission, RAMFAC, state internal revenue services like Lagos State, Abia State, Anambra State, and others. Then the Federal Capital Territory Internal Revenue Service, FCTRS, and many private companies and individuals, which we cannot begin to list here. So, friends, you've seen it, how you can be able to reduce your tax by simply increasing your deductions allowed legally and decreasing your deductions not allowed legally and ethically. If you have any issue, please ensure you contact us. And please, we are releasing as many videos as possible to all of you to educate everyone. So for you to get it hot and fresh, please, we advise that you quickly like, subscribe, and share this video so that not just only you, but other people can benefit. Thank you so much and have a beautiful day. Thank you.